This video is about adjusting position size according to volatility. Hello, I'm Peter Martin with Trading 212. Now, position sizing is an important aspect of trading. We've said before that one idea is for beginners to start small and slowly build up their position size as they become more comfortable with what they're doing. Now, another idea that some traders like to consider is to normalize the cash risk of their positions across different markets according to the volatility of those markets. Now, this is basically an attempt to keep the variation in cash value of those positions as being roughly the same no matter what market you're trading. So put simply, if you're trading a more volatile market, this would mean adjusting the position size to be a bit smaller, or if you're trading in less volatile markets, to adjust the position size to be larger. Now, why would you want to do this? Well, you don't know when you trade which trades are going to go well and which trades are going to go wrong. Let's say, for example, that you take 4 positions, 3 of them go well and 1 goes wrong. What you don't want to have is that the one that goes wrong actually ends up with being the outsized loss because it just so happens to be a more volatile market and that you hadn't chosen your position size according to that volatility. So what I'm going to show you how to do is to take an objective measure of volatility and use that to normalize your position size across different markets. Let's take a look at some charts and see how to do that now. I'm going to start by looking at crude oil as my first market. Now, the volatility measure that I'm going to use is called average true range. How that's calculated isn't particularly important. What we really need to know, though, is that it is an averaged measure of how much the market has been moving. So let's right click and select indicators, volatility, and there at the top of the list is average true range. So I'm going to click on that and we open this dialog window that prompts me with a default of 14 periods. Now I'm looking at a daily chart of crude oil here, so this is talking about 14 days. What I'm actually going to do is change that to 21 days. Why am I doing that? Well, that's a kind of typical number of trading days that we get in a month. So this is looking back over the last trading month and giving me an average measure of how much the market has been moving over that period. In other words, the volatility. Now, as I said, I'm looking at a daily chart for my example, but there's no reason you couldn't use different periods if you traded over different time frames. With a daily chart, though, this is something you would only have to check periodically, say once or twice, once a day or twice a day, or perhaps once a week. Whatever you feel allows you to stay on top of changes in volatility. So I'm going to click confirm, and there is the average true range at the bottom of my chart. I'm only really interested in the most recent value corresponding to this most recent candle. And the easiest way to see what the exact value is to change my crosshair here to a crosshair in tooltip, because then if I hover my cursor, I get to see the value. So we can see the average true range is 1.71 there. Now let's just quickly compare that to another market. Let's compare that to gold. And I've got the 21-day average true range also added onto this chart. And if we look there, the average true range, the most recent value is 10.31. So we can see that gold has a markedly different value in terms of average true range. So right off the bat, we can see that if we just traded the same size in both markets, one is going to be giving us more volatile changes in profit and loss based on this historical volatility measure over the past month. So very generally speaking, we'd want to try and adjust our position size to try and take account of this. So let's look at an example of how we might do this. So if we go back to oil, and if I right click and select open detailed trade box, we can see that we can put in a quantity here. Now if I put in 1 and click confirm buy, it says that it's too small. Minimum quantity limit, the quantity must be equal or greater than 100. So we could use 100 just as our example as a starting point. It's a very small trade size. So this is 100 units of crude oil. Now the unit of crude oil is a barrel. The price is per barrel. $54 per barrel is the buying price, and we're looking to buy 100 barrels. So when we look at this average true range, which we said was 1.71, that's the average daily fluctuation. If we did 100 barrels of crude oil, the dollar value that we could say is our average daily fluctuation is 100 multiplied by that 1.71. So it's $171 is our average daily fluctuation in a dollar value. So that dollar value is the notional value that we want to try and make the same across each market, and the value that we would be dividing through by average true range in order to normalize it according to volatility. So if we were to take that $171 and just remember that value and go to gold, we said that the average true range was 10.31. If we go to another trade box, once again we're putting in a quantity here. Now the quantity we want is $171 average daily fluctuation. Divide that through by the average true range, which we said was 10.31. It gives us a value of about 16.6. Now we can't actually put in a point number, so let's round that to 17 units. Now the units for gold are actually ounces because this is priced per troy ounce of gold. 1,320 roughly dollars per troy ounce is the buying price. So $17 with an average range of around about 10.3 gives us a dollar value in the same sort of region as we were talking about for crude oil. And then similarly, if we move on to a currency, let's have a look at euro dollar. So the average true range here we can see is 0.00668. So that's rough. That's saying that's around 67 pips per day is the average true range of euro against dollar. So once again, if we open a detailed trade box, we want, as we said, that daily fluctuation to be the same as crude, to be about $171. We're dividing 171 by 0.00668. And that would actually come up with a value of about 25,600 euros as our trade size. Our position when we trade in euro dollar fluctuates, the profit and loss, it varies in US dollars. So we're commanding a fixed amount of euros with a fluctuating value in US dollars because it's 25,600 euros worth of dollars that we'd be commanding. So that really is just a very quick look at how to normalize a dollar value across different markets. Remember, this is all about trying to create a theoretically consistent position size across those different markets, if that's something that you want to do. It doesn't in any way cap your losses. If you're looking to cap losses, then you have to introduce the idea of stop losses. But this is just an idea of trying to keep your position size consistent according to the volatility of each market. So that was a quick look at using average true range, a volatility indicator, as a means of normalizing your risk across different markets in the web app. But don't forget, you can download for free native mobile apps for iOS and Android. And you'll find links to those in the video description below. If you enjoyed the video, please hit the thumbs up button and give us a like, or why not share your thoughts with us in the comments section. We do read each one. Now, as well as doing these educational videos about trading, we also do videos with analysis of popular markets such as gold and crude oil, Eurodollar and the Dow Jones. If you click on the subscribe button and then select the alarm bell icon, you'll get a notification for every new video we add, and we upload fresh content weekly. But that's all for now from me, Peter Martin, and Trading 212. Thanks for watching. Bye-bye.